Hi everyone. So in this video today we are going to talk about mortgages versus renting. Should you keep on paying rent or rather should you just consider having a mortgage? And for you to clearly understand the difference between the two, I think first of all we go to the definition, we'll go to what you need to consider for you to be able to choose between renting or having a mortgage. So first of all, what is renting? And renting is something which everyone knows. You're paying your monthly rent to stay in a property, but you don't necessarily, or rather, those payments don't necessarily lead you to owning that property. And a mortgage is basically a loan that you receive to help you own a property. So this loan is majorly a loan that will expect you to maybe, let's say, pay a certain percentage for a deposit. Then the rest of the percentage is covered by your loan provider. Then you'll be making monthly payments to that specific facilitator, and these payments will make you will lead to equity. And by equity, I mean eventually you'll now be the owner of this land. So there are several differences, pros and cons for both rental properties and mortgages, and that is exactly what you're going to look at. And by the end of this video, you will be in a much more better decision to position to make a decision as far as either go and start paying rent or continue paying rent, or rather just get a mortgage, pay for it, and be sure that these payments will lead to ownership. So what are the pros and cons of renting? So first of all is flexibility. And currently, right now, personally for me, I'm not really sure whether I'll be staying in this specific location for the next like 10 years. I need something that is very flexible in that if I get, let's say, some hustle somewhere, or if I want to move somewhere, it's a decision I can make this month and move tomorrow. Then lower initial costs, because for you to be able to rent a place, the only thing that you need is, let's say, the deposit and the first month rent. So it is very easy for you to get a rental place because there is nothing like pay this huge sum amount or pay this percentage for you to be able to come and live at this specific house. Then no maintenance cost. Technically for me, I live in a rental space. So basically, if I have issues with my floor, if I have any repair or maintenance issues that are supposed to be done in this specific property, I simply liaise with my landlord and he's able to come and fix all those things. Now, the cons are no equity. And by this, I mean, even if you stay in that rental property for 10 years and you're paying, let's say, 50,000 monthly, at the end of that period, that property is still for your landlord. So these payments do not lead to ownership. So no equity. Then unpredictable costs. Tomorrow you might wake up and find out that your rental has increased. I remember there is a while I was living in a certain property and we were given a month's notice and we were told after this month, following come next month, your rental expense has gone up by 10%. So it is up to you to choose whether to stay or leave for another property. So that is something which you cannot really control. Then limited customization when you come to a place, and that is why when you're looking for a place to rent, kindly find a place that suits you, because you have limited customization. You can't put wallpaper on the walls. You can't, even in some properties, you cannot mount your TV because then say, hey, you're spoiling our wall. There is that limited customization. So you need to look for a property that clearly suits your needs. Then let us look at the pros of having a mortgage. First of all, equity building. And this means that the monthly payments you'll be making towards this mortgage payment will lead to the ownership in the long run. Then we have property appreciation. So technically, let's say the value you've bought in this house is 10 million. You are guaranteed that, let's say, in the next 2 or 3 or even 10 years, this property's value will have increased to, let's say, 15 million. Then stability. So stability means that if you have taken a loan of 10 million and let's say you deposited, let's say 20%, that is 2 million, and you have 8 million to pay up to, no, it will remain like that. So it gives you time to plan and arrange yourself within making those specific payments until the loan is over in that defined payment period. Now, what are the cons? So high initial costs. As I told you, in rental, you only need to pay, let's say, the deposit, which is usually equal to 1 month's rent. Then you also pay the first month's rent. So assuming you live in a house that you're supposed to pay, let's say, 50,000. So basically, you'll just take 50 plus 50, that's 100,000. So that includes the deposit, apologies for that, plus the 1 month rent. Now, in mortgages, let's say you're going to buy a house at 10 million. They'll come and tell you, okay, you need to give us a deposit or the down payment of 20% of that value. So that means you need to have a startup or initial capital for 2 million. So once you pay the 2 million, now the 8 million you'll pay over time within the defined period of time, okay? So it is usually quite high for most of the people to manage this. The long-term commitment, I think for mortgages, they might even ask you to commit to paying this 8 million for like 20 or 30 years, or even 10, 20 or 30 years. That is a long-term commitment. You're just paying rent, you're paying loans towards filling up, or rather you are paying that 8 million for that period of time. I think that is way too long. Then maintenance costs. So when you have already taken a mortgage and this is your house, all the maintenance cost is up to you. That includes, let's say, if that land appreciates and accrues land rates, you're supposed to pay. Any maintenance cost in that house is liable to you because you are the property owner. Now let's give a practical example between the two. Now, in a rental expense, first of all, if you're paying, let's say, 50,000 Kenyan shillings, that is the initial cost that you just need to take the deposit and the rental. But when you come into the mortgage, the initial cost is a percentage of the total amount attached to that specific property, which can be lump sum. Now, ownership, even if you live in that rental space for 10 years, you will not own it. But on the mortgage, the monthly payments you're making leads to ownership of that specific property, okay? So if, let's say, for example, we take 50,000 Kenyan shillings in a whole year, you'll have already paid, I think that is 12 times 5, that is 600,000 in a whole year. Now, multiply that by 10, that will be almost 6 million. So if you live in that specific property and you're paying 50,000 Kenyan shillings a month, for a period of 10 years, you'll have paid 6 million shillings to that landlord as rental expenses for that specific period of time. Now, when you're taking, let's say, 10 million Kenyan shillings in the sense of mortgage, then you have paid, let's say, the 20% of it, and let's say the remainder you're supposed to pay for the same, let's say 6 years at 20% interest rates, or rather you're paying, let's say, 77,000 in premiums on a month-to-month basis for a span of 6 years. So this will bring your amount to around 9.2, which might be higher than that 6 million. But now that amount that you've been paying on a month-to-month basis will definitely lead to ownership. Now, what are the factors you need to consider when you're thinking about, okay, should I continue renting or should I take a mortgage, then just get a property for myself? First of all, financial stability. You see, for rental, you can live in a place when you're not guaranteed that your payments will be stable for the next like 5 or 10 years. Because if today you're living in a house of 50,000 and things don't work out, you can move to or readjust to a house of 30,000. It gives you that flexibility. Unlike a mortgage where you're supposed to be paying, let's say, 77,000 monthly, it sticks to that for like 20 or 10 years. So you must make sure that you're actually financially stable, and that will help you make a decision to either stay on a rental basis or rather get a mortgage for yourself. Then long-term plans. So renting. You see, for renting, you have to determine, okay, is this the place where you want to stay for like the next 10 years? Or rather, are you unsure? Maybe you might move somewhere else, or rather you are in a career that gives you an opportunity to maybe be traveling and you want to be traveling with your family, so it really not make sense for you to get a house in that specific place. So based on your long-term plans, you will be able to decide whether to take a mortgage or not. Then maintenance responsibilities, as I've told you, on rental, it is on the landlord. On the mortgage, it is on you. So even if you pay the 77,000 monthly, you will still be liable for meeting all the maintenance costs of that specific house. Paying the land rates if it accrues, paying the other bills if it accrues, the service fees, the renovations that you want in that specific place will be solely put on you. So you can't just say that I am able to pay the 77,000 and that's it, but you also need to look at your income generation. Are you able to sustain the expenses that are attached to you owning that specific place? Then investment potential. If you're not too keen at investments, okay, you might maybe consider the rental place. But if you're keen at investment, you might take this mortgage, take that house, develop it, because in a span of time, those specific houses that you acquire will definitely increase as far as their value is concerned. Then tips for making the right decision when you're doing this: find, first of all, calculate the affordability. Because if you're staying, I've interacted with people who pay even 150,000. I remember there was a while back when I had friends, I still have them in High Ridge, and they were telling me that in this place, the houses range between 150,000 to even 200, and they were paying this on a month-to-month basis. And to me, if they would maybe consider even having a mortgage or something, I think that would really make some financial sense. Then consider future income growth. Ensure you're comfortable with handling these payments on a month-to-month basis. And this is not a job where maybe you're working on a contract for 2 years, then you're jobless again, looking for another contract. You need to make sure that my income is stable for the next like 30 years. My income will remain stable, and I might even increase on the income that I'm receiving. So you'll be much better paying these monthly payments. Okay, then explore rent to own options. If, let's say, maybe we really have several companies, I'm not really going to mention them here, and these companies tell you, okay, what you're going to do is, first of all, pay this deposit, then you'll just be paying, let's say, some flexibility of even 30,000 a month. And in a span of, let's say, 3 years or 5 years, you'll be able to own this property. There are companies that have come in Kenya and they've made the ownership process to be as comfortable and also as efficient as possible. Then prioritize your financial goals. So let's say, is equity a top priority for you? Or if it's not, maybe you're looking for a place where you can just continue paying your rent, then save for a deposit later on. So if you're somebody who thinks like, I don't really need a loan or taking a mortgage, what I need is put my money at one place, invest it, then once it is enough, I can develop my own property. So you clearly need to prioritize your financial goals and consider them with the long-term goals that you have, okay? So with this said and done, thank you so much for sticking to the end of this video. Thank you so much for the support you've given me for the 2 months. I really do appreciate it. Happy holidays from my family to you, and have a good day.